Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Ayaz Motiwala. He's perched out of Hong Kong, has looked at India very, very closely for a number of years, and probably used to specialize for an early part of his life on the consumer space, and since then looks at all things macro and micro. And it'll be lovely to understand from him whether he sees harder evidence of an economic recovery or is it looking fragile simply because the dollops of stimulus are still not able to sustain the boom that the economy would specifically like, and therefore in such a stance or in such a scenario, what is his portfolio positioning? He joins us right now. Ayaz, great having you. Thanks for joining, and I presume you're still based out of Hong Kong and joining us from there.
Yes, good morning, Neeraj. Yes, I'm indeed right now talking to you from Hong Kong. Thank you for
Okay.
having me.
No, the pleasure is ours, Ayaz. So, Ayaz, wanted to understand from you, how do you see the narrative of the Asia Pacific region and India as well? Is there clear, tangible evidence of an economic recovery with some bit of hiccups because of various variants? Or do you believe it's nearly impossible to say that right now? Why or why not?
Yeah, so yeah, like honestly, the second wave which has come in has has sort of messed up the statistics on some bit of the recovery which we were noticing after the first wave. To be very objective and more specifically about India, right? So and so the evidence needs to be a lot more that these are not sort of one-off purchases which were post the first wave in a whole host of sort of industries from sort of automotive, home improvements, etc. Where we saw a very sharp recovery as evidenced by volume growth numbers, as evidenced by plant utilization of steel and cement companies, etc. So, parking that numbers on that side, we've had again a very similar and a sharper wave towards the end of March this year and going through almost the whole of April and early part of May. And post which we are seeing again a very sharp recovery, indeed, based on what the numbers which have been reported for the first quarter, as well as what the management commentary has been post results, where they've talked a little bit about their current scenario, whether it's through the month of June, July, August, etc. So I think we remain hopeful that the nascent recovery is indeed a recovery and not a one-off sort of purchases by consumers or industry in terms of sort of placing an order book, etc. Stretching that to other parts of Asia, and the relative argument is that India is this large sort of market where investors have the opportunity to put in large size of money where there is activity and action on the ground, whether it is the old industry 1.0 and the new industry or the challenges which are coming in the form of the private equity funded companies causing a huge disruption in the market. So there is a lot of stuff going on in India. If you cross compare that with the Asian counterparts, even the larger ones such as Indonesia, possibly Thailand and Philippines, there is a lot less sort of excitement in terms of companies being funded or the whole sort of change in the guard and what have you in terms of the internet economy, etc. So I guess investors obviously are free to choose where they want to go, but I guess the India positioning stands out, and in relation to what is happening across our neighbors, that is an added sort of dimension, if you will, because I don't think people make asset allocation calls, that in that such short-term fashion. But I think this will have a long-term bearing. So as investment committees meet or as allocators meet, this quarter and the end of the year, this would be clearly what your show talks about, a massive talking point in these investment committees, where they would cross compare, sort of the opportunity a large market like India offers in the Asian region in relation to a host of other countries, including the situation in China and the Southeast Asia markets that I talked about.
Actually, that's just a brief point, Ayaz. In your conversations, maybe within your firm as well, while there is so much of how do I say conversation or chatter around one, of course, the COVID origins and therefore supply chain diversification and therefore investment following that, as also the recent crackdowns, and we've seen what's happened to the casino stocks overnight because of the clampdowns or supposed clampdowns in Macau. Do you reckon investment committees, as they meet for the next year, will we will take a hard look at that? Because thus far, a number of stories that come on Bloomberg, for example, say that while there is a lot of chatter there, there is enough and more allocation happening to China because of the perceived valuation comfort in the hard economy stocks of China.
Yeah, so just quick numbers, Neeraj. These are hard numbers in terms of the Greater China allocation, including Taiwan. As per, let's say, agencies such as MSCI. If you were to look at those numbers, they're in the high 50s. I mean, this is basically Taiwan, China, Hong Kong, and all of those put together. So there's no going away from that. So if you are talking about, as you said, there is a lot of noise around it. But if you see, the casino business in Macau, or the education business, or the gaming business, or even alcoholic beverages, etc., there's a lot of talk about that. But the fact of the matter is that there is a large amount of money already put to work. So when we talk about these committees talking and trying to look at a potential allocation shift, we are talking about going back a decade and a half back, where India was probably placed even below Malaysia, and India used to be sort of 1 and 3% weightage, right? And that weightage is now moved to a ballpark of 8 to 12%, depending on which strategies and which committees that you are trying to follow on. So that's a substantial move that and a journey that India has sort of covered. And we are in the ballpark of Korea and Taiwan. And the size of the economy, the opportunity of growth which lies ahead for India, makes a very, very solid case for these wise people to take note of the situation and take these relative sort of calls going forward. In our specific sort of situation, we are indeed deeply connected with India. We are India investors. We as is known, we have this domestic PMS business, which is fully an India opportunity, as well as the offshore fund, which invests more than 50% in India. So we are fully there, looking at bottom-up opportunities. And the point I was trying to make was that this would bolster the case of an increased allocation. It might be gradual and more subtle, but it is the direction that we would head to.
Got it. Now, there is, never mind, again, the fears of maybe a third wave, etc., that are lurking. We saw decent participation both on the FDI and the FI front when it came to India, Ayaz. My question is there tangible evidence to an investor's mind, because investors tend to look 6 months out? So is there tangible evidence to your mind that if we don't get a very severe wave 3 in India, then the economic recovery might have more legs? Because there is some evidence of the initial signs of private capex, in that cement and steel companies are starting to do that, ethanol companies are doing that. It's a small fraction, but still it's a widespread thing that is happening out there because of government policy and the PLI scheme and the PLI schemes in the other sectors. And the government capex of the infrastructure plan that the government has spoken about, and we still have to see tangible evidence, but still it's out there. Would you believe that led by capex, the Indian economic revival could actually be not just a story, but a reality 24 months out?
Absolutely. In terms of the upfront expectation is indeed going to hopefully play out. And the key sort of high level points to think through is, there could be independent sectors such as real estate, which have gone through a very long cycle of sort of sideways move and a buyer's strike, so to speak. Prices were up. The business was in a bit of a mess. Completion schedules were off for a toss. and the whole issue on account of demonetization and RERA norms, etc. May be a sector-specific issue there, and that could be also partly driving in this recovery. But the reality of entrepreneurship and entrepreneurs taking investment decisions to put up capacity is really what they see in front of them, and so they are just waiting for this opportunity, and the buyers are coming in. Whether it's the steel demand led by housing or steel demand led by infrastructure built out, as a case in point. I think it's just a matter of time that these things are going to build up. The challenge is that this has been going on, mind you. So India selling sort of in the ballpark of 100 million tons of steel has been going on. The excitement is about growth, and so the evidence is, as you've pointed out, and I probably call out, that we are talking about maybe a one greenfield plant, but I think all of the 4 or 5 majors are putting up brownfield, which is adding up to a capacity of between 18 and 20 million tons of steel, which is a nice 20-25% growth. The utilizations are not even fully there. So they are kind of bargaining for a 40-50% kind of growth there, right? And so investors like us are always have the opportunity to play directly, whether it's a real estate or a steel or a cement, or what we are trying to choose to do, which is to participate in other pieces which make sense, let's say. So you've talked about this in the past. In the real estate sense, you could look at the tiles and the pipes manufacturers and a host of other participants in that value chain to create an apartment or a house. Similarly, in the steel cycle, you could look at what should you say, refractory companies as such as one of the examples to participate in the value chain. So there are ways to participate this and go forward.
Okay, Ayaz, you mentioned just a follow-up. You mentioned the demand for hard commodities, and there is evidence in some parts that it is out there, despite the Delta wave hitting. My question to you would then therefore be based on what to do with the companies which are within this business, because there has been, at least for the metal names, a dramatic recovery from the lows. Forget the prices on the valuation front as well, not just the prices. While oil and gas may have lagged behind a bit, now they're starting to come to the fore again. What's your sense about companies in the hard commodity business, metals, oil and gas, what have you? What is your stance there within India, maybe across the Asia Pacific region, but specifically in India?
Yeah, so I'll make an attempt to make some sense out of it, in the sense very quickly, which is, let's say steel, which is an international commodity traded and can be transported and sort of imported and exported. The challenge on steel per se, whether it's India or the rest of the world, has been that the capacity built up has been very poor. That is, and in fact, there has been obviously closures. That's the big call that the steel bulls have had on China, essentially, right? And so there's been a capacity crunch, and the landed cost meant that a few million tons of steel landed up into India, but otherwise it's been a home show, essentially. And these homegrown players have not really added capacity. What has happened is, obviously through that IBC setup, there's been a little bit of restructuring, and the ownership has changed hands in a couple of large steel mills. Like it typically happens of a recovery, that you have first the utilization and then the pricing, and that is a signal going back to corporate finance managers to reach out to their teams and set up this investment plan. So we are moving forward in terms of this evidence, as we talk about the fact that the large 5 players have signaled already plans to put up a brownfield capacity. So they obviously see the next stage of it, which is they made some money out of this whole situation as well, as I said, and then the demand situation is quite robust. And at that elevated sort of prices, they think that if the supply comes in and the prices were to settle even lower, they could start off with a good utilization and justify this sort of capital investment. So this is just one example of how this would happen at the micro level with multiple enterprises, whether it is in the in the cement business, whether it's pipe expansion, ceramic tiles, paint companies, both public and private. All of these guys are actually going through this sort of response, right? So if you look at, let's say, paint companies now, just switching gears, I mean, the kind of volume growth that is being demonstrated by the largest player to the number five is not being seen in the last 4 5 years. And the confusion lies in what was bunched up from April 2020 to, let's say, August 20. And is that one of that, or now that this Delta variant has come in again, we are going to see bunch of buying. So once that thing were to clear, I think we'll be in a much better position to call out this recovery as a sustained recovery.
Interesting. Just wondering, Ayaz, would the difference of growth between number one and number five in paints, for example, be more idiosyncratic in nature? Because number five would also be an organized player, a large one compared to the fringe players in the unorganized space. And the belief was that organized is eating up unorganized. But in the paints, could it be that the number one and number two have such a dramatic lead on multiple other factors that they are doing that? I don't want to restrict this to a paints company, but since you brought that example, I just wanted
to ask. Great question, Neeraj. That's a great question. I'm happy you bring that up because I would say we could extend that to a broader argument, as you point out, which is and this is being written across in press and in other forms, which is that immediately post the demonetization, which was way back in November 2016, I think the call was made for this conversion into organized from unorganized, and we see that playing out now. And also the added reason is that 2 waves of COVID have hit these sort of unorganized players, in addition to further issues on account of accounting, GST, etc. Right? So those businesses are really being badly hit on their ability to raise private capital, to be able to manage 2 rounds of working capital till their the supply chain paid their money, etc. Whereas the organized guys are geared better, and they started immediately sort of running once the wave settled down, which is last year and then this year. So whether you look at paints, as we are participants of that kind of value chain, sort of paints, pipes, tile industry, from a home building and that side of the business, it is very clear that even the largest guys are continuing to win market share, both from the smaller organized players as well as from the unorganized market. It's visible across the board. So that's where the sort of growth argument would come in, to the point where we are in terms of this positioning in the market. So if I have to bring that point along, because we are not functioning in vacuum as such, right? So the point that I'll bring out here would be to say that, let's say the markets are very elevated. You held that question back. I'm sort of preempting it. And we've had this beautiful ride in the market for the last 18 months. And the question is, what is being implied or baked into these expectations? And so that is essentially the hope of growth on these guys, based on, as we talked about, partly or primarily on account of market share gains in a slow growing market for now. And then there is a tailwind of the market recovery as well. So at this juncture, this is how we are positioning for a host of companies, an example being this sort of business of home improvement. And if these were to play out appropriately, where the growth indeed comes in, then we would have hopefully the share price sort of playing out appropriately. And the flip side of the argument is, the third wave, the US rates, inflation, and all the macro commentary that is talked about, including an issue on China, etc. We would be challenged on, stocks having a sharp sort of prospect of derating, and that lurking correction that we've talked about, time and again. So, through this point, I've made a few points on how we're thinking through all these things. Yeah.
Yeah, but I want to pick on one of those, Ayaz, and then I'll wrap up with your views or comments on the BOFA Fund Manager Survey, which came out overnight. But before that, a point on what you just made, which is that some of the larger players are gaining market share versus the smaller ones. And um, I draw your attention to the valuations at which some of these players might be available at as well. Now, at every single point of time when companies are trading at stratospheric valuations, people find reasons for why they should be doing so. But I think you yourself would also want to make that point about how when companies are bought at extremely high valuations, then the returns tend to be sideways even if growth is there. And I think we've seen evidences of this in the past, as you probably wanted to bring out. So how do you juxtapose what happened to some of the FMCG names back in
Right.
the last decade to
Right.
what could happen to any of these players currently, be it FMCG, be it these home improvement companies and the paint companies, or technology for that matter?
Sure. That's a great question, Neeraj, and you put it together very well. So I'd firstly sort of say for ourselves that we are seeking value while being growth investors, sort of like a WIGS investor. I mean, this word is used internationally as well. And so now the point of value is this debate that, we've paid up a multiple to purchase these high quality companies, and hopefully their growth comes by, their ROE is protected, and their payouts are good, etc. And if that were to not happen, as the historical point that you bring out, and let's talk about the biggest sort of company, or one of the biggest companies of our times, which is Hindustan Unilever, and it had almost an 8 to 10 years of a sideways performance, starting I think 99, 2000, all the way to 2008, 9, where then they had a new management change, and the growth came back. So they were challenged at multiple levels, and that's what is the historical evidence that we should be picking up essentially, right? Which is this is a chart that you show on how it has done sort of more recently. But if you see that flat line for a long period of time, almost a decade, that's the point that I'm trying to talk about, which is they had very ordinary growth, again in relative terms to what was happening in the marketplace. All the way from 2001 onwards to 2005-6, especially that period where their growth was very ordinary. There was a lot of excitement. There was, infrastructure recovery, and play there, real estate and otherwise. So investors' money was also going there in trying to chase for growth, whereas this company or this set of companies were not being able to deliver numbers. So the risk we run going forward is of that type, where we are very excited on a paint company, or on a pipes company, or a ceramic tiles company, or what have you, and the growth expectations are belied, and that runs a serious risk of compression of multiples, and not really making the money which is expected out of it. So a great company, as you point out, and to paraphrase it, need not be a great stock or a great investment if it is bought at inappropriate valuations, and that's the message we'd also like to put out, because that, I mean, at near lifetime highs, that's what we should be focusing on. So one is the return dimension, and second is adjusting for these kind of lurking risks. They're not going to happen tomorrow, but they could be the prospects based on which we are sort of trying to build our portfolios.
And these are what? These are in the pockets of all, I mean, these are all themes. I mean, so my question to you is just to simplify this. And I'm not asking you to take names. I'm not asking you to tell us when is it that you would exit these names, if you would exit them. But are these in the pockets of all the company, all the themes that we spoke about, which is home improvement, which could be FMCG, which could be IT? Is it spread across all? Because that's where we see signs of exuberance.
Yes. And so now just shifting gears and bring up another sector, since you mentioned that IT, let's say, right? I mean, so there is 4-5 years ago, when the two L&T cousins, if you can call them, went public, it was probably the lowest point for IT valuations and IT expectations, let's say, right? So we probably know that TCS and Infosys were in the ballpark of 17 and 20 times earnings, and the two L&T stocks were listed in the ballpark of 10, 12 times, right? And those stocks have gone multiple X's over the last 5 years of listing, from 17, right, or under that. And they are now being valued at a fairly elevated level, because we are in obviously a very very robust growth times, where management commentary on calls has been that we see this once in 1 or 2 decades. More recently, a Wipro call, right, where they're citing probably Y2K and now this digital opportunity, right? So the question is, how do we weigh this versus what we are trying to pay up? And while it is indeed difficult, I think what we are trying to say through this conversation is that we should be mindful of these facts and take sort of investment decisions based on those expectations. And so with the Unilever argument, there was also an argument. I think Infosys, Wipro post the 99-2000 bull market took many years to take out those highs, essentially, right? And that I think that is the key to making sort of long-term compounded wealth. Whereas we will cite the index numbers at 13-14% over last 10-20 years, but the fact of the matter is that these numbers are not even and distributed in every year similarly, right? So those are the risks that we should take care of. We've had a nice sort of period of performance, and just putting on positions on past legacy will have subpar or below expectation results. So even if the expectations are this sort of nominal GDP growth or this past historical 13-15% growth for Indian equities, that may not happen in the next 12-18 months. Who knows? Based on this sort of point that if we were to have a departure and a decline in valuation multiples, then it will take some time for that to recover based on earnings catching up. So that I think that needs to be kept in mind. And returns are not equated. So I think people should keep in mind what is the level of risk being assumed, whether it's through small cap stocks or mid cap stocks, or for that matter, large cap stocks. I mean, we've had a couple of banks and large entertainment media companies, etc., really losing a lot of market cap in the last 4-5 years, as large cap companies as well. So it's not a certain sector or certain market cap size. We have to be mindful of that fact that for the amount of money you're putting to work, are you being compensated substantially enough for the risk being taken?
No, that's a very valid point, and risk-adjusted returns should be the forefront of every investor's mind. Yeah. Ayaz would have loved to speak about a lot more, including near and medium-term growth, but we've done our time, at least on this conversation. Maybe the next conversation could be dedicated to that, but it was lovely having you and understanding from you a few finer points. So thank you so much for that.
Thank you, Neeraj. Pleasure.
Pleasure was ours. And viewers, thanks so much for tuning into this edition of Talking Point. Keep in mind, before we wrap up, I just want to leave you with this thought. While everybody's grappling with what to do within versus growth versus value, I don't know if we have those graphics, but the BofA Securities Global Fund Manager Survey very recently, which came out overnight, in fact, speaks about this, that the key takeaways for them is that the second point, which is the inability of the fiscal frenzy to sustain the boom, equates to maybe flipping out from long cyclicals to long healthcare, tech, and banks, industrials, EU barbell. Now, it's a thought that some fund managers have, not all. Who knows who is right? But here you heard the views of Ayaz Motiwala and how he would want to position his portfolio. Thanks so much for watching today.